when you look at the true fundamental process, I sort of break it up into 4 steps. And I've written about this in a few different annual reports. The first thing I do, and it's pretty unique, at least it's unique to talk about it this way. Most people, I think, want to be creative. They want to come with everything needs to be their own idea. We have built out a 13F analysis. We've actually now built it out with Python scripts, so it happens pretty quickly. And what we do is I look at every single quarter a group of about 100 different highly successful value fund managers. So these are concentrated funds that have long-term holdings that go in, they're maybe allocating $100 million for the next decade into a single position. So they have huge teams perhaps, or they have put maybe hundreds or thousands of hours and maybe even quite a bit of money into doing this research. And then it pops up on their 13F. So 13F is just a filing with the SEC, and every fund with over 100 million just files a 13F every quarter. So you get a snapshot. And if you look back at the last snapshot, you can see what they bought and sold. And there's really very few changes that happen in most portfolios, but every quarter we look at this and then we get a superset of all of the firms that are owned by all of these value funds. And the list is actually quite large. It's sort of like 400 to 500 different firms. And if we're sort of always looking at this is step 1, okay? But if we're always kind of around this basket, this superset of super investor investments, we avoid a whole lot of mistakes. And we don't necessarily need to pull them right off this list, but they are breadcrumbs that will lead us to a great investment. So maybe we see that there's a CEO who's also the chairman somewhere else, or we start to recognize some type of value, or that there's this new business model that everybody's investing in. And so this 13F analysis is enormously beneficial. I don't hear many people talk about doing things this way because everybody wants to come up with their own great idea, but there aren't that many mispriced securities in the market. So you probably all know the efficient market hypothesis. All information flows in the market at all times. Every price is correct. But we know from like the success of the Berkshire Hathaways of the world that there are anomalies in the market, but there just aren't that many. So how do you find the needles in a haystack? And I think through this 13F analysis, we're looking at more needles than most people are looking at. So if there's 10,000 investable securities, in a moment, we narrow it down to sort of 400 to 500. And I think the error rate is much lower inside of those. So the second step is what you would imagine. It's the fundamental analysis. So, we can throw out firms that are outside our circle of competence, that look too difficult, things that we maybe have looked at in the past and aren't interesting, things that just look very expensive. And it may drop down quickly to a few dozen firms that we want to dig into in a given quarter. And by the way, because our turnover is so low, because the firms in our own portfolio we know so well, a lot of times when we bring in new capital, we're allocating it to the cheapest position in our portfolio that is already in our portfolio. So we don't need that many new ideas. Really 1 or 2 ideas a year is totally sufficient to manage a successful fund. In fact, Charlie Munger was just talking at the Daily Journal meeting, and I don't remember the exact quote, but he said something about how if you're trying to build an incredible portfolio, you're lucky if you have 4 opportunities. So, and he sort of described the 4 that are in his whole family's portfolio, including kind of Berkshire Hathaway and a few others. So you really don't need very many. So we do this fundamental analysis. So that's what we're really looking for in the fundamental analysis component, is what I just described. There's the Graham approach, there's the Fisher approach. We want it to match both. And what we want is we're looking for the very best business models in the world, and we're looking for the greatest management teams in the world. The reason why we're looking for the greatest management teams, among other things, is that these are sort of off financial statement value. So everybody's screening for stocks as opposed to like doing a 13F analysis. And when you screen for stocks, you make type 1 and type 2 errors in statistics. You basically are pulling in false positives and you're rejecting false negatives, and you end up with a poor set to work with. And because everyone's doing it, everyone's looking at the same poor set. So I think the 13F is superior. It's a superior approach to just like screening, which is what most people are doing. Then you get into the fundamental analysis, and people again sort of start screening or looking at basic metrics. What we're really looking for is off financial statement value. Because everybody else is screening, the only way to be, you have to be different and better to really outperform. So then you make your process different and better. So what we do is we're looking for the greatest business models, we're looking for the greatest management teams, and then we're looking for a very inexpensive price, right? And when we find a firm that satisfies all that and is part of them, on these other 13Fs, it's probably owned by multiple other value investors. And now we really see why. It just jumps off the page. It becomes very clear and obvious. You need to understand, anytime you buy a security, someone else is selling it to you. So somebody's making a mistake. I mean, there may be a reason that they're selling it. Maybe they're going to buy something else, but somebody is making a better transaction. So you need to understand, why is everyone else selling it? Why is someone else scared while I'm looking to buy? And a lot of times it's because what I like to find is off financial statement value that will seep into the financial statements over time, and then the price will reflect the real value. But maybe it's because management is so superior. Maybe it's because there's revenue that's just missing. Maybe it's because they've pulled costs forward or made huge investments that are going to pay off over time. Maybe it's because they don't have net income and they're reinvesting in the business, and they're reinvesting at 30-40% IRRs, and they have no net income, and everybody's scared of them not having income. So there's different reasons why that can exist. So that's step 2, kind of identifying those firms, and they're hard to find. They're not just everywhere. So you have to be very patient. You have to do a lot of digging, and the third step is what I just described as structured value. So that's looking at how we buy. So is there a TARP warrant? Is there a convertible bond? Is there a option contract? Can we go out multiple years? Can we write a put contract and get a discount to this? Like what product are we going to use to get a better price than you can get on the NASDAQ or the New York Stock Exchange? And so that's the third step. And the fourth step is figuring out the position sizing. And that's a lot. It's interesting because at a high level, we use the Kelly criterion to sort of guide our sizing. And then we use another few sort of objective strategies to also guide our sizing. But at a fundamental level, if you listen to what Charlie Munger says when he says you can only find 4 good ones in your, for your portfolio, Warren Buffett says you should only make 20 investments in your life and you'll do better than everyone else. Well, why don't I pause there, and then we'll jump into the Kelly criteria in a minute, because I don't want to be too long-winded. But what I will say is that it is pretty advantageous. I think most people should be way more concentrated than they are. Even most professionals should be way more concentrated than they are. What happens with diversification is, as you start to introduce your 10th, 11th, and 12th holding, you're introducing positions that are most likely inferior to your first and second and third best idea. And they're probably going to be somewhat correlated to another position in your portfolio. So what you're doing is you're on an average, you're going to reduce your returns and you're going to not reduce your volatility because it's correlated to something else. So you'd be better off, rather than investing in your 15th idea, just put that money back into your first idea and you'll do better. So, so that's sort of very high level. We can talk a little bit about the Kelly criterion if anybody'd like, but that's our process. And then, and then we end up with a concentrate portfolio of great businesses run by great people. Often we have very respectable co-owners of these businesses. So whether it's, Bill Ackman or Guy Spear or Warren Buffett, there's a lot of good names in the firms that we own, which also offers a bit of protection against sort of corporate raiders and other things. So there's a lot of subtle advantages to the process I've just described.